Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Good morning, Dodge. Lots to discuss heading into the new trading week, thanks to some important developments at the end of last week. Shall we start with the latest jobs numbers in the US? Now, what does it tell you about the US economy? And subsequently, how do you think it could influence the actions of the Federal Reserve?
Well, good morning, Melissa. I think that our economy is adding a lot more jobs than was expected. So I think it's the fears that we're flirting with recession are beginning to ease. But workers took home smaller weekly paychecks. The average work week fell by 0.2% of an hour. And our average hourly earnings also fell 0.1%. So bottom line, more will be able to spend, but not all will be able to spend more. So it's not going to be a perfect fit, and we're going to have to continue to struggle with growing revenues, and hopefully that will occur over the next couple of months as the fears of recession hopefully continue to go into the depths, into the shadows of what we're looking at. But there are no signs there's been a meaningful pickup in wage growth. It is unlikely that the Fed will be pushed into raising their rates at this month's meeting. There could be more of it to be in play after that. But if you take a look at the markets on Friday afternoon, they were pricing in at least one Fed rate cut this year, just one, and perhaps a small chance of a second rate hike by the fourth quarter. So there is really not the growing pressure to increase rates, and there should be a delay beyond this month.
Okay, so we're looking at perhaps later in the year. Now, you mentioned fears of recession has eased, Dodge, but Jim Rogers, the investor, he told in a recent interview said that he is certain the U.S. economy will be in recession in the next 12 months.
Yes, time is on Jim's side. Historically, there has been a recession every 4 to 7 years. Yes, we're going into the 8th year, but what's happened is the time between recessions have been lengthened by the Federal Reserve policy. The big question, Melissa, is can easy monetary policy bridge the period between recessions so that we might be able to avoid a deep recession or maybe avoid it completely if we can get to the other side? That's the question that we've been facing for some time now. It is possible that a recession can be avoided. It is quite possible that the recession that Jim is talking about might not occur. The probability is quite high. It's much higher than what most are expecting. And in terms of just the pure economy, the possibility of recession is not as much. But when you start to look at the markets, stock markets, and we've had a bear market run, we are having a nice run now to the upside, but still within the bear market context. So his call may be more correct in looking at market performance as opposed to economic performance.
And as we know, the economy doesn't necessarily reflect the market, or the market doesn't necessarily reflect the economy. What are you watching, Dodge? I mean, are you optimistic about prospects in the U.S.? Which side of the camp do you fall onto?
I'm taking much more of a short to intermediate term look than the longer term. I do believe that it is time to start to consider adding to equity risk, but not across the market. Gold, I think, will be good. It's having a pullback right now. Steel and other material issues are doing very well relative to the rest of the market. They are outperforming. We're also looking at select retail stocks. We believe that an overwhelming majority of energy issues have seen their lows for this cycle. And on the negative side, we're seeing last year's biggest winners displaying horrid relative strength and basically topping out, like Amazon and Google, Netflix, McDonald's, Starbucks. So we are seeing some real opportunities to increase equity risk, but on a stock-by-stock basis and not across the board. We're also seeing a great deal of sector rotation, something we have seen for some time now, but we need to get beyond sector rotation in order to have more of a longer-term move to the upside.
Well, HSBC is in fact urging caution when it comes to buying a dip in stocks. They're actually warning of a slowdown in corporate earnings. Also, they're saying, US equity valuations are not that attractive. Do you think that these concerns are legitimate, Dodge?
Yes, HSBC does have two areas that it's made a good point. First, the slowdown in corporate earnings, as you were talking about. Yes, there's been a great deal of talk about the profit recession over the past few months, and it is quite possible in absolute terms. Also, lofty valuations now are certainly becoming more attractive over the course of the recent downturn. But it's still hard to snap up market bargains and to buy pullbacks, as they're saying. What we're seeing is a sector rotation where opportunities occur, but not from a longer-term value investment point of view. It's really stock picking, stock selection, and we think it will continue. So we're somewhat in line with HSBC, but we're more open to taking opportunities in the shorter term.
Okay, well, from the US, shall we take a quick look at China now, Dodge, where over the weekend they had a huge annual policy meeting and they lowered their growth rate for 2016, now at a range of 6.5% to 7%. This is the first time that they've set a range instead of a hard and fast number. Why do you think they've done so?
I believe that they are recognizing, the Chinese government is recognizing the economy is in fact decelerating. They're trying to take away encouragement from the local and provincial officials to distort their numbers. They're trying to shift the economy away, the economy's growth away from a reliance on manufacturing and debt-fueled investment, which is what the government can control, towards the services sector and the consumer spending, which is not as controllable and needs enthusiasm from the individual consumer and individual services. They're wrestling with overcapacity in traditional industrial sectors. The manufacturing activity continues to wane. So they have some real risks that they're beginning to have to recognize in how they value their economy and how they measure the growth. The health of the economy, the slow pace of the reforms, the systemic risk in the housing market, shadow banking sectors. All this is playing into their need and their belief that they really need to move away from one number to the ability to look at a range and perhaps to be better able to manage growth within that range. So I think it's a good move. I think it's more reasonable. I still think they're going to have a hard time meeting their goals.
Yeah, because Alan Greenspan, the former Fed chairman, he said that these growth targets are in fact unrealistic. So you share almost the same view that 6.5 to 7% is going to be a tough sell.
It's going to be a tough sell. It's how the growth slows down, and whether it's all at one time or is it over time, and it really represents more of a transition in the Chinese market. That is what I'm hoping. I do believe that it's still over-optimistic, but I'm hopeful that the deceleration of their growth will occur over a longer period of time and allow the rest of the world to adjust, as well as the Chinese government.
Fantastic. Thanks for your time, Dodge. That was DodgeDorland, Chief Investments Officer of LandorFuest Capital Managers over in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6.